A giraffe. A cute giraffe. Not only that, but this cute giraffe's name is Jeffrey. Toys R Us is just genius at marketing to come up with this. And it makes sense, right? Because more than girls, we all know that giraffes just want to have fun. And just like girls, giraffes only want to have fun with their toys. Because, well, a man has never been able to truly satisfy them. But still very cute though. Oh God, Jeffrey, are you okay, man? You're just taking a nap, right? Yeah. But who's that strange man who looks like he could possibly be a Wall Street hedge fund manager? Jeff? Oh God, Jeffrey, did that hedge fund manager shoot and kill you? Just like hedge funds killed Toys R Us? How could this happen? Well, that's what I'm gonna explain in this video, how Wall Street killed Toys R Us. Yeah. So now guys, when I say Wall Street killed Toys R Us, that's just my opinion. There's a lot of different ways to look at it. Like, a lot of people thought Toys R Us was gonna die anyway, so it wasn't Wall Street that killed it. And really, you can decide for yourself as I explain what happened, and I'd love to know what you think down in the comments. So make sure to write something up while you're watching. Okay, so this Toys R Us thing is a two-part murder story. First, you had the private equity firms come in and, mess up Jeffrey a little bit. Then you had the hedge fund guys come in to finish him off. It's that classic Wall Street double team. Or at least I think that's what they're talking about when they talk about double teams. Okay, so the first part is with private equity firms. And what they do is basically deal with private companies. So they'll acquire them and then manage them and then sell them again. And there's a lot of different ways that they do this. Like, they might take a public company private and then IPO it again, or they might just take private companies and operate them and then sell them. But in this story, these PE firms took the public Toys R Us private. And this happened back in 2005 when Toys R Us was really struggling. They were facing real stiff competition from Target and Walmart. And then of course, there was one other company that was growing real fast. Can you think of which company that is? Yeah, it's Amazon. I can't make a single video anymore without mentioning Big Bad Bezos. I wonder if he even has friends anymore, if he even gets invited to dinner parties. Because honestly, probably everyone he knows has had their business ruined in some way by Amazon. Must be tough being Jeff Bezos. Apart from the billions and billions of dollars that could probably make up for all the lost friends, but Anyway, so Toys R Us was a distressed company, and then here came the PE firms. Now, it was a group of them. It was Bain, KKR, and there was even a real estate company that came in too. So those three came together and carried out a leveraged buyout of Toys R Us for $6.6 billion. So a leveraged buyout, or a LBO, or a LBO, as no one else calls it but me. What that is when an acquirer takes out a bunch of debt to buy a target company. And for the collateral for that loan, they actually use the target company's assets. So it's not even their own collateral, they're betting the company to buy the company. And all that debt is taken on by the company they're buying. And then that company is on the hook to pay off all that debt through their cash flows. So yeah, the private equity guys still put in equity and money of their own, but most of it is funded through the debt. So it's basically like going to the bar and buying a bunch of drinks and then just putting on the other guy's tab, which is just a great deal, right, for the acquirer in these situations. And these leverage buyouts were one of the tactics that were real popular in the 80s, back when Wall Street was hot with, like Gordon Gekko. And you remember the young Charlie Sheen before he was winning? And actually, he lost a lot in this movie. But all the Gordon Gekko-like hostile takeovers were done through leverage buyouts. So these three firms took Toys R Us private, but Toys R Us ended up with $5.3 billion worth of debt from the deal. And that large amount of debt basically became how most people describe their spouses. It was like a huge ball and chain just holding them back, sucking the life out of them until debt did them apart. Toys R Us had something crazy like $6 billion worth of interest payments. They were shelling out $400 million a year to try and cover that. And 12 years after they went private, they had still not even made a dent in that debt. And that's because they had to divert all their cash flow to reinvestment in the business. The whole point was to make it successful again and then IPO. But the problem was that they always just had too little money to really make an impact on the business, because a lot of their money was still going to the interest payments for that debt. So they were stuck in a real catch-22, just being crushed by that debt load. And how are you supposed to function as a business like that? So for example, their plans to revamp all their stores, even though it was successful in their test cases, they couldn't expand it to all the Toys R Us's because they didn't have enough money. And the same thing with their online strategy with subscriptions and delivery options, they couldn't put any of that completely through. Servicing the debt took up all their cash. So 12 years later, which was last September, they finally declared bankruptcy. All the debt those PE firms saddled them with was too much. But Toys R Us was not dead, because the point of the bankruptcy was so that they could get out from under that debt and restructure their company so they could come back. But while they're in the middle of their restructuring, all of a sudden this past March, they announced that they're done for good. They shut everything down. Why did they do that? Well, this is where the hedge funds come in to finish the job the PE firm started. So the hedge funds that got involved are the distressed debt hedge funds. So what these guys do is go into special situations like the bankruptcy of companies and buy their debt for really cheap. They buy it for pennies on the dollar with the idea that they'll get a good return in the future. Now, you might think that they would be betting their money on the turnaround of the company, because if the company does well, then they'll be able to pay off that debt that these hedge funds bought for really cheap. And that's how the hedge funds will make their money. But that's not always the case. So Toys R Us was one of these cases where they were selling the distressed debt. And this is when the hedge funds came in and bought it. One of these hedge funds, Solus Alternative Asset Management, bought Toys R Us debt for 50 cents on the dollar. And once they bought that debt, they became Toys R Us's creditor. So they had power over the company's finances. And what they decided to do was to go around to the other 4 debt holders and convince them that Toys R Us was worth more liquidated than alive. So all the debtors decided to come and ask Toys R Us for their payments immediately. The cash that Toys R Us was trying to use for the restructuring immediately got diverted to these debt holders. And these debtors had the power to do that because they had secured debt, and the way it was structured gave them the ability to call on it at any time. So that's it. Their restructuring can't go on anymore, and Toys R Us has to shut down for good. But I mean, look at this Solus Asset Management team. They look like nice guys. I mean, one of them even looks like a Jeffrey, and why would a Jeffrey want to kill another Jeffrey? Then you got a Charles looking guy who probably goes by Chuck, especially in the summertime when he's hosting his annual chili cook-off. He seems like a great guy. But then you see that one guy sitting in that armchair just lurking in the corner. And his name is probably something like Nathaniel. But he's one of those guys, you know, where if you meet him, you're like, oh, Nathaniel, Nathan, can I call you Nate? And he's probably like, excuse me, Nathaniel is my name, please say it properly. And you wonder like, what's wrong with this guy? But what you don't know is that on his first day of school, he went to school and he was like, hey guys, my name's Nate. And all the kids were like, Nate? That's a stupid name. And then you know they probably started teasing him like, Nate likes to masturbate. Nate likes to masturbate. And then Nate is like, no guys, stop it, I don't like to masturbate. And then he went home that night and he's like, damn it, how am I gonna fix this? And he's like, first step, I'm gonna change my voice. There, that's better. And from this day forth, I shall be known as Nathaniel. And then he asked Nate Sr. to switch him from public to private school. And you know, it looks like it pretty much worked out for him, because now here he is running a successful hedge fund that destroys kids' dreams by taking down their toy stores. And Nate spends all his time trying to get back at those kids in elementary school that made fun of him and made him scared to ever masturbate again. But this is all really just speculation. I have no idea what these guys are thinking. But because of what these hedge funds did, Toys R Us had to shut down for good. And 33,000 people lost their jobs because of it. And because of the way everything was structured, they're not getting any severance pay either. And they're losing all their benefits. It's horrible. And that's just on the Toys R Us side, but there's a bunch of vendors that thought Toys R Us was going to restructure and come back, so they kept supplying toys. And at minimum, these vendors together are going to have a $350 million loss, which will lead to even more layoffs and more jobs lost. An example of this is Mattel, who Toys R Us was their second biggest customer. They're losing millions and reporting huge losses and had to lay off a bunch of people already. So there's a pretty big ripple effect when you take out the largest toy store. But the good news is that bankers and lawyers got hundreds of millions of fees in this whole thing. Roughly 370 million, so thank God. And estimates are showing that Solus will indeed make a profit on their Toys R Us distressed debt play. And actually, this type of liquidation of companies is their strategy. They actually said so in their 2012 investor presentation. They explained how liquidations of companies after buying into them produced higher and more reliable returns. And I mean, to hell with the effects that it has on normal working people as long as their investors are getting returns. So it's pretty clear to see here how Wall Street really screwed up Toys R Us. Okay, with the PE firms, maybe they were trying to turn it around because they did lose $1.3 billion themselves in their investment. So they failed in turning it around and put Toys R Us in the ground with all that debt, but maybe at least they tried? I don't know. But these hedge funds that came in for the distressed debt wanted to liquidate from the beginning. They wanted to put the final bullet in Jeffrey's brain. Now, none of this is illegal, it's all fair play. But is it wrong? You know, I don't know. Tell me in the comments. See, me personally, I'm a little biased because, as you know, I'm a positive guy. I like investing in positive outcomes. I like going long, strong companies. You know, I focus on momentum. Like, I don't think it's necessary to have investment strategies that end up hurting people, because there's so many different ways to make money, right? You can be positive and invest in good companies that help people and make money at the same time. And maybe it was inevitable that Toys R Us would go under, but that doesn't mean that you have to help it get there. And you don't know for sure either. Toys R Us could have had a successful restructuring and came back strong, but now we'll never know. And this isn't the same as short sellers shorting a company that's a fraud. They're actually doing a public service because that company is hurting consumers by tricking them. This liquidation of Toys R Us's debt was not that. They're just selling toys to kids. And if you remember, I actually talked about this same kind of situation in Billions. That was a few seasons ago, I think, where Axe and the team were debating whether they should bankrupt this town so they could get their payoff, because they were invested in the town's distressed debt. It's a pretty similar situation to this Toys R Us thing. So if you haven't seen that video, I'll link to it above. But I would love to hear your thoughts about what you think about this whole thing. Is it right? Is it wrong? Does it even matter? It's just all capitalism, or what do you think? Let me know. And if you want to learn more about this whole thing, then check out the description of this video. I put some links to articles in there that will explain more. And by the way, if you love this video and want more like it, then make sure you subscribe to this channel and hit that bell for notifications of future videos. We publish about 3 a week, all markets and business related. So subscribe, and I'll see you in the next video. Stay fallible out there. Bye.